welcome to Week in Markets. I'm joined by Joe Forward, investment analyst, and today it's our job to really unpack the key events from this week, and there's been certainly a lot for markets to digest. So we've got an 8 minutes to try and get through a lot. So we're going to keep it focused, keep it relevant, and keep it focused on why it's important for the investment environment. So Joe, we started on Monday with news within the technology space with new AI technology from DeepSeek, which reported that they were delivering AI special technology at a much reduced price than what we're hearing from the tech giants in the US. So can you just talk us through what's happened, how the market has taken that news?
Of course, as you mentioned there, they've released this AI that's essentially more efficient and at a cheaper price. And what this has done is it's spooked the market in terms of some of the bigger tech names. So what's likely to happen is, your Nvidias, your Microsoft may actually have to start reducing some of their AI prices, which will then affect, the margins and the profits, and therefore their share prices have been a bit rocky at the start of the week. But really, what was quite promising for us is that the sell-off was kind of limited in tech and maybe some of those AI-related sectors, such as, utilities, which was going to benefit given the sort of demand for AI data centers and demand for energy. So you did see a bit of a sell-off in utilities, but looking at the rest of the sectors and the rest of the market, it was actually okay, and they kind of looked through it. And I think that was kind of positive for us, because one of the concerns that we maybe had was, if you did get this tech sell-off, would you see some contagion into the rest of the market? And the positive was that we didn't see that, and actually the rest of the market kind of looked through it and was positive.
Yeah, and I think, if you think about how we're thinking about this, new technology from DeepSeek, other potential competitors to the mega cap US technology firms in terms of bringing in cheaper alternatives to AI technology, really should reduce or lower the barriers to entry, make it more accessible to more businesses, and ultimately boost productivity. So there are some real positives, and perhaps that's why the broader US equity market and global markets have actually taken it in its stride.
Yeah, and it's probably why we like to be multi-asset investors. Just because there was such a narrow sell-off in one particular asset, we're actually, we're multi-asset, we're invested in all assets. It means that we're protected from these kinds of sell-offs.
Exactly. Super. So if we move away just from technology and just thinking perhaps about economic data that's come through this week, we've had central bank meetings, we've had inflation data, but I think it's quite interesting if we just do a compare and contrast of the US versus European economies, where we've had data this week which continues to highlight the divergence between the two regions when we look at economic growth, when we look at inflation, and also this week interest rates. Joe, do you want to talk us through some of the key highlights?
Yeah, so starting with the US, they decided to hold interest rates at 4.5%. And that was really down to the economic activity is still expanding, so there's no sort of real growth concerns there. Inflation still a bit sticky, still high, so they don't want to be reducing interest rates too soon. So maybe if you contrast that with somewhere like Europe, we've seen a 0.25% cut in interest rates in Europe, and that's really down to that. Actually, it's a bit of a weaker growth environment in Europe. Inflation, albeit appears sticky now, what they're saying is that down the pipeline, they're basically seeing some easing of some of the inflationary pressures there. So essentially this allowed them to make that cut.
Yeah, and we actually had the likes of France and Germany report inflation over the last 24 hours, and that was actually coming in slightly better than expected. And as you say, the European Central Bank cut interest rates by 0.25%. Markets are still expecting them to cut interest rates, I think, by 0.75% by the end of this year. So that'll take interest rates in Europe to below 2%, real positive in terms of risk assets. They've been responding well. And actually, we've seen new all-time highs within European equities and UK equities in January. It's quite incredible, really, the returns that we've had so far. If we look at somewhere like Germany, up 10% month to date, France up 9%. So equity markets really contrasting with the economic environment in Europe, where you've got a bit of economic malaise, but the stock market's really driving higher. So that's good from an investment perspective, and given that we're global investors, our portfolios are exposed to Europe. I suppose just thinking about corporate earnings, that we're going through an earnings season right now where companies in the US, Europe, globally are reporting their fourth quarter of last year earnings results. Any standouts from this week?
I think just looking at it at a broader level, maybe just looking at the US to start with, we've had about a third of the index report, and generally you've seen earnings and revenues beat estimates, which is good. I wouldn't say there are any sort of really standout ones, but the ones I've been having a look at, the first one was actually Apple. Now they managed to beat their earnings, but it was largely driven by some of the services they provide, so things like Apple Music, Apple TV. What disappointed was some of the devices, so wearables, such as the Apple Watch and iPhone, just disappointing in sales there. Yeah. So you did see a bit of a positive reaction in the share price. Other examples, IBM, on this AI theme, have actually seen a really strong demand for AI, and hence have beaten their earnings expectations, beaten revenues, and you've seen a real sort of increase in the share price. So I think on the day was up around 13%, and that's actually the biggest increase in the IBM share price since way back in 2000.
Yeah. So I suppose really encouraging from an investment perspective that, yes, we've got the stock prices moving higher, all-time highs, but the earnings that are being delivered are following through as well. And that's certainly something that we've been talking about as an investment team, looking to the next 12 months, coming off the back of a very strong year last year in terms of the returns that we've had from risk assets. What's going to drive equities higher this year? Well, it has to come really from earnings, given where valuations are. So if that's positive signs coming through initially, that should be supportive looking forward. And I think perhaps we just finish off and just reflecting on the returns that we've had within risk assets in January. We've had positive returns from equities, but we've also had very strong returns from likes of gold, positive returns also within bond markets as well, high yield performing exceptionally well. So from a multi-asset perspective, it's been a great time to be invested. So we'll finish on that positive note. So thank you, Joe, and thank you all for watching. Have a great weekend, and we'll see you on Monday.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.